It's the bond market back in focus this week, and it's all ahead of the UK budget. Hello everyone and welcome back to Morning Markets here at True Potential. For those of you who joined us in the Week in Review last week, you'll notice that with Matt Henderson, we spoke about rising bond yields. And that's what we're going to carry through today ahead of the UK budget tomorrow and of course the US presidential election next week. Now, despite the cuts in interest rates we're seeing from central banks, particularly the US Federal Reserve last month, bond yields, particularly two-year bond yields, have risen. So we saw a 50 basis point cut from the US Federal Reserve last month, but two-year maturity bond yields have risen by 50 bips. And that's because markets likely overstated the degree of economic slowdown in the US. Jobs growth there has proved healthy. Inflation remains sticky around about 3%, and estimates for Q3 GDP are strong at 3%. So the economy is nowhere near recession, and in fact is growing materially above trend. And that likely explains why expectations for future interest rate cuts in the US have been dialed back. If we go back 6 weeks, markets were expecting interest rates there to fall from over 5% to below 3% by the end of next year. That seems unlikely. Some of the rise in bond yields is also the Trump trade. Markets braced for a higher probability of President Trump returning to office. Trump is pro-fiscal spending. We would likely see more tax cuts, the rolling over of existing tax cuts, and spending on other initiatives. So bond yields are adjusting for that. But we don't quite have that tailwind here in the UK. So why have yields here risen in line with the US? And in fact, why do we have to pay to borrow at the same rate as the United States Treasury? Well, it's partly to do with the nature of our spending. The UK government already borrows around about 100 billion a year, mostly for day-to-day spending on public services. It's pretty clear that the Labour government are now going to increase that borrowing. So despite what they do with the debt rule to try and make that our public debt load fall as a percentage of GDP over time, the markets are braced for a bigger supply of gilts over the next year or two. And that's why we're seeing rising borrowing costs here. But we're also going to see quite a broadening in the tax base. Taxes are going to go up away from the major pots such as income tax and employee national insurance contributions. So other areas are going to see substantial increases in the tax burden. And that is likely going to be a headwind for growth. And again, bond markets don't quite like the concept of headwinds for growth and a much increased supply of bonds. So it all comes to a head tomorrow when the Chancellor will reveal the true nature of the increased spending and the increased tax burden. Now, much of it has been leaked, but there's likely to be one or two surprises. It will also be key to look through the OBR's projections for growth. They are likely to have to revise down some of their growth expectations and also revise up their borrowing expectations, even aside from any extra borrowing announced by Chancellor Reeves. So we're seeing two different phenomena across the Atlantic. One is stronger growth, stronger tax cuts coming in the US, but here it's the opposite. Growth remains weak and taxes are likely to go up. So please join us tomorrow where we'll give some more flesh on the bones there. We'll be able to give insights into what's likely to happen and also comment on some of the US data with regards to job surveys and also employment costs. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.